Quantitative easing 2, we've got a lot of talk about quantitative easing 3 and 4 and 5 potentially coming to the fore, because many say that it doesn't matter how much money you throw at the US economy, we will not see a sustainable recovery unless on the ground demand recovers. What is your view on that, and how is it going to affect investments in South Africa?
You're right about quantitative easing too. I think what has happened in the US is that the consumer in the US has been a structural shift in their thinking and their mindset. They've really moved from a consumer that's been overspending, overborrowed, to a consumer that's now reducing debt and also being a lot more prudent and a lot more fiscally conservative in their spending habits. So what Bernanke is trying to do is trying to keep interest rates so low to encourage them to spend. But in spite of interest rates being so low, they're having difficulty getting the consumer to spend. So on the other side, what he's also trying to do is to try and force investors into more risky assets, to try and push up equity markets around the world. Assets just pushing up prices so people can get back the confidence. But that also seems not to be working, because what's happening essentially is that with the low interest rates, all it's doing is moving money from people that are close to retirement, individuals especially. It's moving money from them, to corporates, and that includes financial services companies. They, on the other hand, because they've been burnt so badly and they're being a lot more prudent than before, they don't really see demand coming through, and they're just hoarding the cash and not reinvesting it. You can see it with BHP Billiton as an example. They've had now 3 attempts at company takeovers, although they are at the moment trying to expand current operations, in some 1 or 2 big operations coming down that will be coming to fruition. What they are trying to do is, instead of buying or investing in more productive assets or new mines, they're actually buying existing companies and not creating economic growth by doing that. So globally, we run the risk of another asset bubble occurring with the low interest rates, and the world is a different place. So longer term, we could see the party going on, asset prices going up, but at some stage it's got to stop, and you just don't know when it's going to stop.
Of course, Asief, at the same time, we've had a big impact on commodity prices and currencies in particular. And of course, that's one of the issues being discussed by the G20 at the moment. How do you see this playing out, particularly on the currency front, because that does have a big impact on the South African market?
The problem with the currency market is that both the US and China are effectively manipulating the currency at the moment. China's got a fixed currency. The US with the QE2 is encouraging their currency to be weaker, and you can understand why the US is doing it, because it's trying to kind of stimulate demand and reduce the level of exports from China. The negative implication for that is that in South Africa we've had an appreciating exchange rate, and that's been causing a lot of problems in terms of job losses in South Africa and in emerging markets because of the stronger emerging market currencies. It was interesting that you had a debate earlier on capitalism versus unionism. Capitalism is fine, but just make sure that the playing fields are fair. In this instance, China's got a fixed currency, they're manipulating the currency, and you're not allowing the currency to appreciate and making their goods more expensive. So what's effectively happening is that the playing fields aren't fair, and South Africa and other emerging economies are losing jobs to China. The stronger rand will have an impact on the resources companies or companies that export that are exposed to the rand, and that's not good for our market in the long term.
Well, Asief, at the end of the day, it is all about becoming competitive and gaining that competitive edge, and it seems that no country is going to back down at this point in time. Given that scenario, investors are obviously looking for those high growth companies, and looking at the JSE All Share, we're not doing that badly. We're sitting at around 31,500. The question is, are the valuations at this point in time being reflected in the likes of the share prices, or do you think that perhaps we've run a bit too hard?
If you focus on the forward PE of our equity market, South African equity market, it's about 10 times. It's not. It's fair to cheap if you're using that metric as there. And the other, if you also then compare the earnings yield relative to the South African 10-year risk-free bond yield, the market is also looking fair to cheap on that basis. The big proviso for that low PE, if it holds up, the forward PE holds up, is if commodity prices hold up in this current environment. If you don't, the current risk aversion from Europe, the concerns that's coming out of Europe, might cause a relapse in commodity prices. However, I don't think that's a possibility. So on the whole, I would be exposed to our equity market, not aggressively as I would, let's say, a couple of years ago, but I would have exposure to our market and possibly an increased exposure to resources shares, provided the commodity prices hold up going forward.
Well, just looking at those commodity prices, and of course, a lot of that's dependent on what's happening in China. There are concerns now that China might have to raise interest rates again at its next meeting. And also, just China's diversification of its reserves, because it has been dipping into some of the base metals and obviously gold as well. I mean, is the commodity picture really dependent on how China takes this forward?
I don't think it's just China alone. China is a big factor, and it has a big part to play in demand in commodity prices. India is also another economy that's a big economy, and we shouldn't really leave out all the other emerging economies. They've been running their fiscal and deficit positions a lot more prudently as compared to the US or some European economies. So you are seeing growth in and around the world, although it's not as high as before. But what you must also remember is that there haven't been any big resource finds globally for the last couple of years that's going to increase the supply of commodities in a big way. So that will also support commodity prices. Even if they increase interest rates in China, by increasing interest rates in China, you in fact increase the level of liquidity because people, in China, because people see the higher rates there. So I'm not too concerned about the increasing of rates in China. I'm more worried that what would happen in the South African market context is that the rand continues to stay strong, and that might even create a lot more job losses in South Africa, and then affect retail stocks in an indirect way.
Asief, well, I mean, looking at it from an asset allocation perspective, because you highlighted a few of the challenges that could face the South African economy going forward, I mean, with a strong rand, job losses and so forth. And at the end of the day, we are actually competing against other emerging markets, which are doing relatively well, and they are far more competitive than us. That said, what are you looking at from an asset allocation perspective?
Our internal models indicate to us that the rand is overvalued by about 20% on a purchasing power of parity basis. However, if you compare our interest rates compared to developed markets, the gap will close in the next two monetary policy meetings. We think the next meeting there's a 0.5% cut and maybe another 0.5% thereafter. After those cuts come through, we expect the differential to be narrower, such that we might potentially have a depreciation of the currency. And in light of that, combining it with the purchasing power of parity model, which says the rand is about 20% overvalued, if you combine that over the next year or so, I would be exposed more to rand hedge shares, shares that are exposed to currency movements. I would increase my weight to an overweight resource position, and also what I would do. Specifically increase it, have exposure to gold shares, because I think gold will still perform in an uncertain global financial environment.